All right, so we have a nice little group on the phone today. How's everybody doing?
I'm doing great. This is Lisa.
Good.
Uh-uh.
All right, so this
Doing great,
month,
Dr. Charlotta.
okay, Charlotta, well, welcome. Welcome to the call tonight.
Jeff, get your phone.
Do we have any questions before we get started? This month is all about stocks and the stock market. So we're going to pretty much spend the whole month, talking about stocks and learning about the stock market, understanding more of how the stock market works. Because I think a lot of people have some maybe misconceptions or don't fully understand the stock market. So we're going to talk more about that. I think somebody's not on mute. Sheila, can you just mute everyone other than myself? All right. So one of the things that I want to do is just talk about what a stock is, because we're going to talk about, what a stock is. We're going to talk about the history of the stock market, trends of the stock market, where the market is going. But one of the things that I want you guys to understand is every publicly traded company, their overall worth is based on the overall worth of the stock that they hold. So when a company goes public, they basically sell pieces of the company to everyone who owns a stock. And basically, what that person now owns is a piece of that company. And the hope is that the share of stock will appreciate over time. Does everybody understand that? So if you buy one share of a company stock, you are a shareholder. Everybody understand that? Yes, no, you can type it in the chat. I want people
Yes.
to respond. You can come off mute, but if you come off, go back on, you can type it in the chat. Everybody understands what a stock is. You basically are buying a equity into the company. You're buying a share of the company. Okay, good. Okay. So again, when you purchase a share of stock, and I'm going to use just Apple stock as an example. So if you purchase a share of Apple stock, right now, Apple stock is trading at $180 a share. You are a shareholder. And that stock just gives you equity in the company, ownership in the company. So people purchase stocks because their goal is to be a shareholder. And the hope is that the value of that stock will go up over time. Okay. Another hope is that that stock will pay dividends. All that means is that every quarter, when the company looks at how profitable they have been, they will make a decision as to whether or not they want to share their profits with their shareholders. So every quarter, company can or cannot declare dividends. Questions about that? Comments about that? Questions or comments? Everybody understands that? You can type it in the chat box. No questions. Okay. So when you are looking at investing in a stock, that's the things that you want to consider. One, you want to look at the current share price. You want to look at the share price and how it's changed over time. These are things that investors are looking for when they're buying stocks. So when you hear the term equity, when you hear the term share, that's basically what someone is referring to. So you can say, I have equity in that company. That means that you own at least one share of stock. Or you can say, I bought 10 shares of Apple. I paid $180 for that one share. Okay. Now, you may hear people say stocks are volatile, meaning their value fluctuates. So every couple of seconds on the stock exchange where the stocks are listed, their value changes based on demand. Their value changes based on news. Their value can change based on so many different things that could influence the stock price. So that's why they say that there are volatility or changes or fluctuation in the stock market. So you can literally buy Apple stock at 9:30 in the morning for $180, and then later on that day it might be worth $190. Later on that day it might be worth $170, $160, because it's volatile, meaning that it can fluctuate. Now, different stocks, depending on various factors, impacts their overall fluctuation. Does that make sense? So stocks may fluctuate differently over time, just depending on the things that are influencing those stocks. So right now, real estate stocks are fluctuating probably more than other stocks because of the fluctuation in the interest rates. Does that make sense? Questions about that? The definition of a stock, how stocks change, factors that influence stocks. Again, the economy can influence stocks. Decisions that are made by investors can influence stocks. Shifts in the global economy can influence stocks. So that's why you'll hear people say that it's very difficult to predict if a stock is going to go up or down. Now, there is a thing called technical analysis, which we're going to talk a little bit more about. And the technical analysis is where we can use different technologies and different trends to predict what the stock may do. So sometimes if they're looking at a moving average, or they're looking at how the stock has changed over time, or they're following different indicators, they can possibly predict, but there's no guarantee. So sometimes you'll see people looking at stock charts or stock trends, and they're trying to predict, is this a good time to buy? Is this a good time to sell? And what they're using is technical analysis. Okay. So again, companies will issue stocks when they are attempting to raise money. What they are doing is they are trading out your money for shares of their stock. That's called equity financing. So Apple may say, hey, we need more cash flow. We need more capital. What they're going to do is issue stocks. They're going to put them on the market. They're going to sell them. We're going to buy them, and then they're going to take the money and reinvest it back. The thing is, we have the stock now. It's on the open market. They do not have to give us any money as far as dividends, because dividends are optional. They don't have to make any interest payments because we have now bought into Apple. We're now owners of Apple. So that's one of the reasons why companies will go and issue more stocks, because what they may say is, hey, we need some more money, or we need some more equity financing. We're going to now issue more stocks to raise money. And what are they giving away? They're giving away ownership in the company. Questions about that? Any questions that you have about why companies issue stock or what a stock is? Any questions? So again, how are you going to make money in the market as an investor? So you have now bought Apple stock for $180. Generally, Apple is going to pay out dividends every quarter. So every 3 months, they're going to pay dividends. So that's one of the ways where you make money when you own stock. The other way you make money is if the stock goes up over time, which is called stock appreciation. Okay. Now, some people say, I think investing in the stock market is risky. They say that because they do not know if the price is going to go up or if the price is going to go down. They don't know if the company is going to pay dividends or if the company is not going to pay dividends. So that's the risk associated with investing in stocks. You cannot predict if the price is going to go up. You cannot predict if the price is going to go down. You cannot predict if the company is going to go bankrupt, meaning their revenue will decline and they won't be able to pay their expenses. When you are investing in certain types of companies, which we call blue chip companies, companies that are very established, they have a smaller chance of going bankrupt, but it could happen. Bed Bath and Beyond was considered, a good company at one point. And as you can see, they went bankrupt. Companies like J.C. Penney's. So there are some good companies that over time, they do become bankrupt. But again, it can be very difficult to anticipate or predict if and when this is going to happen. Questions about that? How do you make money as a owner of a stock? Questions, comments, concerns, thoughts?
Question.
Yes.
So if the company goes bankrupt, so that means whatever, say, we put into that, it's pretty much just lost, correct?
Not necessarily. If a company goes bankrupt, they pay out their debtors in a certain order. So it doesn't mean that you're going to get nothing. The issue is when a company gets close to bankruptcy, or they're saying that they're going to go bankrupt or whatever, a lot of times this information is widely known. So the share price will drop. Does that make sense? So the value of the stock will go down. So it doesn't mean that if they go bankrupt, you won't get anything. Oftentimes what happens is the company gets bought out. So their existing stockholders, that company's stock will be absorbed by the parent company, and then you will then be issued shares of that parent company's stock. Does that make sense?
Yes, ma'am.
But generally, if the company goes bankrupt, yes, you're probably going to lose money in the event that you don't sell, before it starts going down drastically. I'll give you an example. Bed Bath and Beyond, right now, their stock is worth 26 cents. Okay. At its height, at one point, it was worth, let me see, back in February 2021, it was worth $35. Okay. And again, that's a company that lost basically 99% of their value because the company's going bankrupt. So most people who own the stock, what were they going to do? They're going to sell it as rapidly as possible. So again, when there's not a lot of demand for the stock, it's going to go down. When everybody's trying to sell it and get rid of it, and they don't anticipate the stock price going up, they don't anticipate it getting any better, then they're just going to sell. Does that make sense, Monique?
Yes, ma'am.
Okay. So let me say this, and I'm jumping ahead. What people do in their individual portfolio, let's say they buy a stock for $100. What most people will do will say, if this stock drops more than 10 or 20%, I'm going to sell it. Most people will put what we call a stop loss on that stock. So if it goes down too low, they'll just get rid of it. They'll sell it out of their portfolio unless they feel like they want to hold it long term. So as a stock investor, if you start buying individual stocks in your portfolio, like you have to decide when you want to buy it, if you want to hold it, if you want to sell it. That's a decision that you have to make. So let's say someone bought Bed Bath and Beyond at $40 a share 2 years ago, and they said, well, I just want to hold it and see. Then they could do that. Somebody might have bought it for $25 and said, well, if it drops to 20, I'm selling it because that's 20%, So again, it depends on the investor. It depends on the person. It depends on their strategy. It depends on a lot of things. So last year, this time, Bed Bath & Beyond was at $5. So somebody else would buy it and say, well, hey, it may go back up, or they may start doing better, or they may get bought out. So a lot of times when people are investing, it's really based on what you feel the value is worth of the company, what you think is going to happen, because just like somebody thinks the value is going to go down, somebody will think the value is going to go up. Does that make sense?
That makes sense.
Yes, and this is Charlotta. I have a question. Okay, so since Tomes is managing that, say for instance, if it was a Bed Bath and Beyond, and it was, say for instance, it was $10 a share, and then it started going down. Now, if Tomes, what is Tomes doing? You have a system set up to monitor that, when to sell and when to buy, because I know the instance that you just mentioned was when we're doing it individually within our portfolio.
Let
Yes.
me,
So,
and this is Ladora. Hi. I wanted to jump in. I want to piggyback on the last question as well. She was talking about the loss. Can you lose? Definitely, you can stay in there and lose. But when you have an advisor, like now, Dr. Natalie said, the information usually is readily available about the company, about the reputation of the company. So, an advisor who has you invested in certain things is watching this news and watching this media, and has stop loss set up.
Right.
Hey, it's dropping
Yeah.
a
Right.
So generally at Tomes, they already have that set up. So if they
Right.
see the decline, then they're going to sell it because they don't want you to lose 99% of a stock. So
Right.
stocks, bonds, mutual funds, things that are easily sellable on the market. As soon as generally a financial advisor sees a decline, yeah, they're going to sell that. I'm just talking about individual people. So let's say you
Right.
now on your own and bought Bed Bath and Beyond. Again, most people, even in their own personal portfolios, will have a stop loss set up because again, they don't want to lose, a bunch of money. Or if they're thinking it's an established company, it may come back, then they may not want to sell it. It's all based on their own individual strategy. Does that make sense?
Yeah. Wanted to make sure that, that was put out there. I mean, I didn't know. I mean, I knew that, but I didn't know if anybody else didn't know that. And that's
Oh yeah, and that's a great point. All of this is just information purposes only, for the individuals who want to learn more about, because a lot of people, we all are being advised, but some people still just don't understand the basics. Some people want to have a conversation with their children or their grandchildren. Some clients want to start a little portfolio for their children or their grandchildren just to help them, but they don't understand the basics. So we want to make sure that you at least understand the basics, understand some of the things that could happen. Now, clearly, public companies they're not having all the companies going bankrupt and things like that. Bed Bath and Beyond has been struggling for years. So it's not like the bankruptcy was a huge surprise. And some companies struggle. Best Buy was struggling at one point and they were able to bounce back. They were able to put some things in place. Target has been struggling because they've been having a lot of theft. That's impacted their stock price. Target is a great company. Walmart was having some issues at one point that was, impacting their stock price. So just because a company has some type of issues or turmoil doesn't mean that their whole portfolio is going to be, or, that the whole company is going to go under. But again, most advisors and people who are investing use stop losses. And again, it's just a little trigger to say, hey, once the price gets here, sell my stock. But that's a great question. Other questions? Other questions? I want to make sure if you have questions, thoughts, because this is informational. We got multiple sessions to talk about stocks. And again, we want to make sure that people understand the ins and outs and that they get their questions answered. So risk is definitely something that we always want to talk about in the market because there is no guaranteed return if you buy a stock. Okay. There's no guarantee that you're going to get a dividend payment if you buy a stock. Generally, again, people will generally make money if the price of the stock increases over time. Okay. That's generally how people are making money in the market. So Amazon and Google were down to, $85, $90 a share over the last 6 months. Now they're at 120. So if you bought them at 90 and now they're 120, boom, you've made money if you sell them at 120. And that's how a lot of times people are making stocks. They're buying them when they go down, and they sell them when they go up. Now, the bright side is stocks generally will outperform other investments. And again, historically, which we're going to talk more about the history of the stock market, historically, the average returns are 10 to 12% a year. Again, historically, doesn't mean that that's what you're going to get every year, year on year. It just means over an average of 10 years, okay, you could see a 7% return. If you averaged out, some years you may see 15, some years you may see 5, some years you may see a decline overall. Some months, the market may go down 10 to 15%, but over the long term, if you look over 10, 15, 20 years, you should see those returns averaging out, which is why it's oftentimes recommended that you let money sit in the market. You buy low, sell high. You don't sell when your money is at a loss. Questions, comments, concerns? Any thoughts, anything anybody wants to share? All right, so there are a couple of types of stocks that you can buy. Most of us are buying common stock because we're getting them off of the internet through our brokers, through our broker dealers. Same thing for if they're buying them through Tomes. 9 times out of 10, they're going to be buying common stock. Basically, again, it allows you to have representation of ownership of the company, and it's also going to allow you to get dividends should they declare any. Now, there are some companies that declare dividends almost every semester, every quarter. Walmart has been declaring dividends for like 20 years every quarter. Okay. And again, it just depends how much money you get is going to depend on how many shares. So if Walmart declares a dividend of 25 cents and you have 4 shares, then you would be owed $1 in dividend interest. And again, that number is going to vary based on if they actually issue out dividends, which again, some companies do, some companies don't. And then sometimes they will make profit and they'll declare a dividend. Sometimes they don't make profit and they still declare a dividend. So again, that just depends on the company and what their method or their philosophies are. So generally, you're going to buy a share of stock 2 ways. You can get it through your broker. You can call up Mario, you can call up the door and say, hey, I want to buy this stock, get it through in my portfolio, or you can set up your own individual portfolio and buy stocks if that's something that you so desire to do. Like I said, we have some people who really want to get them for their kids, for their grandkids. So we have a couple of types of markets. We have primary and secondary. Generally, we are going to be buying on the secondary market. Okay. We don't have enough money to buy an IPO from a Merrill Lynch or a JP Morgan Chase because, again, you're probably buying in huge quantities. We have a lot of money that we can buy from Scottrade, E-Trade, Fidelity, are those brokers who will sell to us. So I could go to Fidelity and say, hey, I want to open up a stock account. I have $1,800 and I want to buy 10 shares of Apple. They would say, okay, not a problem. Put the $1,800 in there, put in the Apple ticker, and now you own 10 shares of Apple stock. Questions about that? So this is just a little chart, again, that talks about why do stock prices change? Because a lot of people have questions, especially when they buy a stock. They're trying to figure out, well, hey, how did this stock price change over time? Is it going to continue to change? Is it going to continue to go up? These are the type of questions that people have. So questions you should ask or things you should know. Stocks, again, are volatile and can change can change rapidly in price. Again, it's about supply and demand. If people hear that a company is going bankrupt, they're not doing well financially, or they don't get a good quarterly analyst report, that could trigger some people to sell. If they feel like sales are going down, or the company is not producing as well as they had in the past, if they have poor earning valuations. So there's no one thing that can say, oh, yes, this is going to make the stock price go up. There are some things that generally make stock prices go down. But again, there's no way to predict exactly what the stock market is going to do. Okay. Questions, comments, concerns? You guys got the floor. I'm going to stop there because, like I said, we're going to be talking about the market all week. And I don't want to overload you. One thing that you could do is just take a little bit of time this week before our next session and just read a little bit on stocks, maybe research one or two stocks. You can go to Yahoo Finance that you might be interested in. And again, you all have a financial advisor who is managing your portfolio for you. This is just additional information for you if you want to learn for yourself, or if you want to teach your children or your grandchildren. Our goal here is just to help build generational wealth and generational knowledge. I know you guys can hear me coughing. I'm a little bit under the weather, so I'm trying to get to the pharmacy by 9:00 so I can get a prescription. But I just want to make sure that if you have any questions, that I answer those questions, because this is a very important topic. This is the basis for all of your investments: stocks, bonds, mutual funds. Stocks and mutual funds are just a collection of stocks. But this is the basis for all your investments. So we want to make sure that people have a good understanding. And remember, there are no bad questions. There are no dumb questions, because the point is for everybody to learn. So please, if you have a question, the floor is open. All right. Okay, penny stocks. That is a great question. So penny stocks are just like any other stock. It's just generally they call stocks that are under like $1 penny stocks. That's all. Or stocks that are low price. And that's what they generally call penny stocks. A lot of these stocks are, again, less than $1, and they're going to be stocks that are still on the stock exchange, but they're going to be less than $1, less than $5. They just kind of call them penny stocks. The thing that you have to understand is penny stocks or low price stocks like that, at times, not all the time, but they can be a little bit more volatile. And we can talk more about that next week, about penny stocks, but that's definitely a great question. And a lot of people are interested in penny stocks because they're trying to identify if that's something that they should buy. Great question. So we're going to unpack more about penny stocks, because I want to make sure that we talk about that. Is it safe to purchase stock on Cash App? I would be honest. I would probably go through a broker like Fidelity, Scottrade, E-Trade, what's going to be, you can even buy them through our current broker. Who's our current broker, Ladora?
Okay, it's TD Ameritrade, and
TD Ameritrade.
Schwab. So it'll be TD Ameritrade Schwab.
Yeah, TD Ameritrade Schwab. So yeah, I don't want to say it's not safe. I don't know anything about purchasing stocks on Cash App, but I would probably go through a more established long-term broker. That's just me. But
penny stock is going to require you to complete a disclosure that you know is a very risky investment.
Mhm.
Stocks are volatile, so I would definitely go through something a little more, controlled.
Yes, absolutely. And we're going to talk more about that next week. So if there aren't any more questions, we're going to just cut it off a little bit early tonight, but there are 5 Thursdays in this week. So you guys are lucky because we're going to get 4 sessions in on stocks. And then our 5th session is going to be our happy hour. So luckily we get 4 sessions instead of 3. So we're definitely going to pick up next week talking more about stocks, the history of stocks, what stocks are. We're going to talk about some of the trends in the market, talk about some of the different indexes. So you guys are going to get a nice mix on the stock market. All right. Well, have a great night, and I will see everybody next Thursday at 8:00. And I'll make sure I give you guys your time back. Thank you. Thank you, guys.
Thank
Thank
you.
you. Take care of yourself.
All right, everybody. Bye-bye.
Thank you. Bye-bye.
Bye.